And we will go now to the first session called Target Date Funds, Objectives, Glidepaths and Benchmarks. In this session, we are going to once again have Mark Fawcett and Nicolas Nefouse. I will introduce them again, although we did introduce them yesterday. But since today we have our colleagues from the countries from our institutions joining us, we're going to repeat this. Let me start by introducing Nick, who will be the first presenter in this session, and then I will introduce Mark. Nick Nefouse, CFA Managing Director, is the Global Head of Retirement Solutions for BlackRock's Multi-Asset Strategies and Solutions, and a leader of LifePath, BlackRock's Global Generational Fund franchise. The Retirement Solution team is responsible for the research, developing and marketing of the BlackRock's life cycle and decumulation stage investment strategies. Mr. Nefouse is a member of the Mass Executive Committee and the Retirement Group Executive Committee. He has spent his career in a variety of roles related to product innovation, investment funds, multi-asset, fixed income and equities. Most recently, he was the head of investment at the Strategy for Retirement Group, where he oversaw the growth of the LifePath franchise, including the development of LifePath Paycheck and LifePath ESG, as well as the expansion into new markets in Asia and Latin America. Previously, he led product development for the Active Strategy platform, overseeing the launch of liquid alternatives, leading strategy for BlackRock's emerging markets and global equity teams, where he developed a series of dividend-oriented equity investment strategies. He has worked at the firm since 2003 in the Princeton, New York and London offices, including his years at Merrill Lynch Investment Managers, which merged with BlackRock in 2006. Nick Nefouse received his undergraduate degree in economics in Michigan State University. He's a member of the board of directors of the Financial Markets Institute at the Michigan State University Economics Advisory Council. He's also a part of the CFA's charter holder and an executive and serves on the executive committee at BlackRock Veterans Network, where he co-funds the Vest for Vets Fund. He is also a mentor and helps civilian careers. He mentors through the American Corporate Partner, ACP. Nicola, the floor is yours.
company stock still owned in plans. That's going to adjust the target date fund. So target date funds don't just operate in isolation, they have to operate in this wider ecosystem. I spent a fair amount of time on this slide yesterday, but this is what we're trying to build. We're trying to build up this model and then understand how to immunize your retirement liability over time. The completion portfolio is the target date fund. That's how we get the growth, and that's how we manage the assets. I didn't talk about glide paths yesterday. There was lots of talk of glide paths, and there was a comment that was made, which I found interesting, which is there was talk of the regulator creating a single glide path. The reason why we added this slide in here is you see a number of different glide paths that BlackRock manages around the world. And that's because we have different inputs here. It's you to different outputs. A glide path is an output of a life cycle model. It is not an input into retirement. This is just the residual. After we put in all of the information, then the glide path comes out. So what you see is very different outcomes within different markets. If you look at Japan, sorry, move over so I can see the colors. If you look at Japan, which is in red, that's at the lowest level. This is a huge level of risk aversion and a very high savings rate. So if I have a risk-averse population who saves a lot, we can't take lots of equity risk. You look at the markets towards the top, US, Australia to a lesser extent, Canada, United Kingdom, very big equity culture, very high amounts of risk-taking, particularly when people are young. All of these things have to be considered into the portfolio when you're designing these. And by the way, none of these are right or wrong. A lot of this comes down to preference. So in the US, where we have a very healthy target date market, the spread between different glide paths is high, and the market then chooses where they want to take the risk within their careers. This is just a hypothetical asset allocation. We chose the UK, even though I'm from America. I try to use as many non-US examples as I can, because I've learned in my global travels, nobody likes an American coming in to tell you what's going well in America. So this is the UK, and this is what we're doing in the United Kingdom. And what you'll see is a similar glide path, though, to most of these markets. More growth assets when young, and then we diversify into more stable asset classes when old. The objective is to maximize growth when you have lots of time and lots of savings, and then you want to minimize uncertainty as you're becoming closer to retirement. Behavioral finance becomes very important when you're moving closer to retirement. The other thing I like about this one is we're starting to implement more illiquids in our UK glide paths. So this has more of the unconstrained approach. The US gets a little bit tricky with the regulations on illiquids. But the idea of this is showing you how we would allocate differently over time. It's not just the glide path. What we're actually doing is linking the asset allocation directly to the life cycle model. So it's not a two-step process where you have a glide path and an asset allocation. So one of the examples is our inflation protection. One thing we know in the UK, in the US, as well as in other developed markets, wages outpace inflation for young workers. For older workers, they don't. So what happens is those wages provide us with more insight in when to take inflation protection. So when wages start to lose to inflation about mid to late career, that's when we want to start incorporating more inflation protection. But one of the questions that I was asked in some of the prep work that we were doing on this is how do we measure success of a target date fund? As my boss likes to say, he likes to tell me that I can't judge you on a 40-year outcome. And that oftentimes is what happens with target date funds. When you talk to target date fund managers, they'll say, well, this is long-term, don't worry. This is long-term, don't worry. Well, eventually that catches up with you. So we designed this for a lot of our client meetings. This is going to be mostly US data, I think, is what we've put in here. But this is how we look at whether or not the target date funds are successful in the US market. And this is where when we talk to our investors will always have target date funds that outperform our target date funds and always have target date funds that underperform. So how do we know whether we're doing it well? And we broke this down into 3 different categories. Whether or not our realized returns are in line with our expectations. That means we have to set an expectation and then either meet or beat that expectation. The second one is, does this align with our philosophy? An old boss I had used to always say, it's okay to underperform as long as people understand why and when you're going to underperform. So in all of our RFPs, requests for proposals, we will put exactly in there what our philosophy is, and then we will tell you when we should have better performance than peers or worse performance than peers. And then the third one is we look at Morningstar categories, and this is what I refer to as the opportunity cost. Even if number 1 is great and we beat our expectations, even if number 2, we're perfectly aligned with what we're saying in our philosophy, there's an opportunity cost to maybe a fund can have better expectations than ours and beat their expectations, and maybe they have a better philosophy. So we have to think about the opportunity cost as well. So let's go through these each individually. This is about trading. I'll come back to this. This is kind of boring. So first of all, when we think about what our expectations are, this is a very busy slide. And the line to look at, though, is the yellow line. That's the most important line. So what happens in a target date fund, we have to establish a benchmark. And that benchmark's a hypothetical benchmark for us. That's how we manage. So when we go out and we establish a glide path and we establish a strategic allocation around our glide path, what we then have to understand is whether or not our portfolio managers at BlackRock are creating value or detracting value by simply managing it versus that glide path. This is simply referred to in index world as tracking error. A negative tracking error means there are fees associated with your management. A positive tracking error means your traders are able to generate a little bit more return than what would be associated in the market. If you look at that yellow strip, once you get out to 1 year, 3 year, and 5 year, you'll see all the numbers are positive. So this is very important. What this is saying is we're establishing a portfolio of about 10 index funds, and we're actually able to beat that portfolio net of all fees simply through our trading with the BlackRock iShares. Oftentimes what you'll find is people will establish a benchmark, and an index fund will often learn that it's the returns of the index minus fees. What you're looking at here is we're actually able to generate slight amounts of positive returns. So very important. Really anything 0 or above is what you're looking for here. So the fact that we're able to do this positive over time is very important. What most of the portfolio managers will tell you is they're able to clip away about a basis point of excess return during a quarterly rebalance. We have peers in the US where these numbers are reversed. They're all negative. So what you're finding is the managers aren't able to even keep up with their own established index benchmarks. So very important of our expectations. This is one of the most important slides that we have in our presentations. What you're looking at here is our expected returns, and then the realized portfolio values versus expected returns. I'll explain this a little bit differently. When we think about defined benefit plans, most defined benefit plans will say something like, we need a 7% return to immunize our liabilities over time. We hear that regularly from defined benefit plans. In target date funds, we have the same thing. So we have expected capital market assumptions. That's how we build our portfolios. That's the orange line. That line adjusts annually. So every January we make an adjustment. These are long horizon capital market assumptions. The dotted line is the realized return of the portfolio. So what you want to see is the dotted line stay between those two green lines, which is plus or minus 1 standard deviation of the CMA. So to say this differently, like a DB plan, we have an expected return. On the 2025 vintage, it's about 7%. That's the slope of the line. Slope of that line is about 7%. For us to immunize your retirement liabilities, we need to make sure that LifePath portfolios are at or above that 7% number. And that's exactly what you're looking at on the screen here. So this is the way that I know that our portfolio managers are, number 1, delivering good value, and number 2, achieving our goal over time. So to say this differently, if you save the right amount of money, if you work the right amount of years, this is the third variable. We have to get you the growth rate over time. And this is showing you that across all of our vintages, you do see that growth rate over time. So what target date funds are just a collection of assets that somebody has chosen based on short-term views. You have to establish this long horizon growth target, which is what the life cycle model is deriving. So second thing we want to look at is that philosophy. How does our philosophy align with the outcomes? So the way that our philosophy is set up in the US, this is US specific, not in all the markets, but in the US market, we say we want to maximize our growth for young investors. So we should have the highest growth for young investors. When we're getting closer to retirement, we want to start to minimize that volatility or reduce that volatility. And then in retirement, we want to focus on spending. So what you're looking at here is anywhere you see, looks like the slide's a little choppy, but anywhere you see gray, that is risk. So gray above the line means more risk. Gray below the line means less risk. Green is return. Green above the line means more return. Green below the line means less return. What this is basically saying is on our long-dated vintages, there's nothing that special about them. We're simply taking more risk, and we're seeing more return than average. It's exactly what we tell our investors. In the middle, what we're starting to do now is we're taking less risk. We're reducing the volatility of the portfolio. And this is where Sharpe ratio really becomes more important to us. This is mid-career, but we're still actually seeing higher returns. This has to do with our asset allocation. And then in retirement, we're significantly more risk averse than our peers. So this is the relative conversation. So in our RFPs, we talk about this. If we underperform in our long-dated vintages in a bull market, that's a big problem. If we underperform in a bear market in our near-dated vintages, that's a big problem. But we establish this within our marketing narrative so people understand the portfolios. Let's go to this one. The other ones say something similar. But what this then looks at is relative to our peers. So we talked about how do we manage versus our own expectations, how do we manage versus our own narrative, and then finally, how do we manage versus our peers? What we're looking at here are rolling 1, 3, 5, and 10-year returns. So not just the trailing, we look at all rolling 1-year periods, all rolling 3-year periods, and what is our percentage hit rate relative to the average peer. So this is the opportunity cost. So what this says, on a 10-year view, LifePath has outperformed 90% of all rolling 10-year periods versus our peers. So this is the opportunity cost point that I made earlier. So we're thinking about how we manage these portfolios. It's not just a target date fund is better than a balanced fund. It's understanding how is your target date fund built to be successful. Let me pause there and see if there's any questions.
Please feel free, siéntanse libres de interrumpir. Esto es mucho más relajado que las sesiones que estuvimos ayer. Si tienen preguntas entre medio, no tengan problema en levantar su mano. No es su mano, lo que tienen que levantar es el acrílico. Para que yo lo pueda ver. Y el público, nuestros compañeros que están sentados atrás, también hay un micrófono inalámbrico donde pueden hacer las preguntas. John y
Octavio.
This one. Yes.
Okay, thank you. So I found it very interesting, your slide that showed the glide paths in different countries. And Japan has a very low glide path because they're very risk averse. And the United States is much higher because we're less risk averse. And I wondered if you had thought about applying that concept within countries. Like if you identified a group of people that were very risk averse, they would be able to Japan and otherwise.
Great question. So 2 parts of that. One, risk aversion is definitely important in Japan, but more important is Japan saves about 30% of their wages. So they don't need to take as much risk. So these are not mutually exclusive. They save a lot because they're risk averse. And because they save a lot, they don't need to take as much risk to achieve that retirement outcome. So both of those are linked. The US has relatively low savings rates. So the only way we can get somebody to better outcomes is more risk. There's no silver bullet in this. So you either work more years, you save more money, or you take more risk. And it's the combination of those things. It's not one or the other. It's the optimization of those 3 factors that get us to the outcomes. If you're saving 30% in the US, you wouldn't need to take as much risk. To answer your second question, some markets we do offer different glide paths. So in the US, we have 3 off-the-shelf glide paths. We have a 50% landing point, a 40% landing point, and a 30% landing point, and then the glide paths have different levels of risk aversion along the path. Again, somebody could select the 30% landing point, but if you're not saving more money or working longer, you're just going to lead yourself to a lower quality of life in retirement.
Seguimos ahora con Octavio y le sigue
Octavio,
Manuel García.
and then Manuel Garcia,
Mike.
and then Mike.
Good morning, Nick. In the slide that you presented, risk and aggregated returns, how do you measure risk? Is volatility over returns? Is the volatility over returns?
Yes.
Okay.
Yep, that's all this is. It looks at each individual vintage and then compares the similar vintages. So Morningstar does great work on this. We'll have all 2040 vintages in Morningstar will be compared, and we look at the total risk and the total return of those vintages.
Thank you.
Manuel.
Hey, Nick. Good morning. Sorry for being late. So I apologize if something I asked you already covered. So on the slides I had the chance to see, you showed us how you compare with Morningstar indicators, so on and so forth. So yesterday we were talking about the importance of a long-term view and a long-term comparison. So how is BlackRock making sure that the metrics are actually comparing against what it really matters for the client, which is pension risk? And that's one question. And the second is about longevity risk. How are you, or probably you will touch it later, but I'm interested to know about the longevity risk. How are you dealing with that?
Okay, so let me do this one, and then I've got a couple of slides on longevity risk that I'll come to. Yesterday was interesting because sitting on stage in the conversation, we had one academic and I would say two academics almost. I'm interested to see Mark on this one as well when he talks in a second. I'm a practitioner, so I have to take what the market gives me and then just deal with it. And in the US, the market deals with daily returns, so we have to show people daily returns. Ideally, we wouldn't show people daily returns. Ideally, we would show people at the earliest quarterly returns. But that's just not how the market is structured. So what we then have to do is create charts like this that show you the hit rates over different periods of time. Because we know that people will trade, maybe not daily, but people are going to trade on shorter term returns. There's some great studies in the US showing that when people choose their individual investments in the 401k menu, they just choose the best performing over the last 3 and 5 years. So to me, that's not very good. The other thing we have to deal with in the US is people can change their allocations every single day, even though we know that there's no positive effect on that. At best, people should be changing them quarterly, if not annually. So I don't have a great answer for you. There's a mismatch. If you think about this slide is we're at about 15 years of data now. There are times where we drop below the line, and if every time I sold, we drop below that red line, you'd have missed the rally, the subsequent rally. This is just something that we have to deal with. So I don't have a great answer for you. Behaviorally, I understand the mistakes. We just have to overcome that with education, showing different charts, continually to orient people on longer term returns. But it's a problem and it won't go away unless they were to stop showing shorter term returns.
Thank you. I ask you to put very close your mouth to the mic, please, to facilitate translation. Thanks.
This is a real question and also a bit of a hint to the people in the room. I totally agree with your professionalisation comment, and that's the professionalisation of risk management by investors. In various countries, and I can speak to the UK particularly, we're seeing professionalisation of asset owners. Now, this is a rather strange thing to say in a country that isn't quite sure that asset owners and investment managers are different. What do you see, and I'm going to ask Mark the same question after he's spoken, what do you see around the world the various markets? But I think the professionalisation of asset owners is key to working on behalf of citizens. I'm just interested in your observations on the professionalisation of those who choose to appoint people.
So if I look at a couple of markets that we're in most, so UK, US, Australia, Canada, you do see that professionalization. So the UK is going down a path very similar to what Australia has done with master trusts being synonymous with supers. So you are seeing that. But you still have that same problem where in Australia, people end up having high balances at the point of retirement, but they have not gotten financial advice. We've almost taken the financial advice away from them during accumulation. And we've gotten them to a better ending point at retirement. They're left with a couple of $100,000, $500,000, $600,000 in Australia, but they've never been taught basic financial education because we've taken all of that away in a good way.
So would you agree that's the next stage for Australian asset owners?
Absolutely.
Yeah.
And that's where, again, it's the next stage in the UK as well. Where
I mean, Australia's ahead of the UK on that one.
Yeah. And the U.S. is not far off. The problem in the U.S. is you have a bifurcation. The people with 401k plans are looking really good. There's a Fidelity just had a piece out recently talking about the growth of the $1 million 401k plan, $1 million 401k investor. And these are not wealthy people. They've just saved 10% of their wages for 30 years, and compounding has taken effect, and they're nearing seven-figure balances. But there's no financial education to help them spend them.
You also got a great bifurcation on climate risk. I mean, that's the other one where, in a sense, different asset owners would take very different views, which is a challenge. Yeah, okay, thanks.
Let me touch on some of the work we're doing, because I think this is important, because I take the US, the UK, Canada, Australia, Netherlands is a little bit different, what we're doing in the Netherlands. But if I take all of these together, they have solved the professionalization on accumulation. And even though we've got issues with education, we have that done. What you're seeing the next horizon really come into is how do you deal with longevity risk, and how do you manage longevity risk? And we say this over and over again. The way that we would do this right now is longevity risk is self-insured, which means you just have to save a lot of money. And we have these wonderful things called savings surplus, which basically means you died with a lot of money, which is not a good outcome. I call it death surplus, so it scares people a little bit more. What we've done then is we have to incorporate insurance policies into the portfolios. And this has been the big advancement we've made. We're launching a product in 2 weeks in the US called LifePath Paycheck. That product takes illiquid insurance. We've negotiated with 2 insurance companies. We liquefy the insurance. It looks like a bond fund that you then embed in the target date fund. So think of it as a forward on an annuity, or an option to purchase an annuity if you want to. So we don't force you into the annuity, we give you the choice. And this is a case study that we did with the Bipartisan Policy Center. I'll just skip to the outcome. What we found is the presence of an annuity in a life cycle model. What it allows you to do is it allows you to spend significantly more money. It's about a 35% increase in spending in retirement, assuming you've saved enough money. And then because the annuity is zero vol, it's not correlated to anything, your total volatility drops by 30%. Yes?
Ursula, the microphone, please.
Yeah, sorry. What I wanted to ask, if this annuity product you're talking about, does it have longevity protection?
Yeah, it does. So again, one of the benefits, we can do this in the US, we can do this in the UK, there's a handful of other markets we can do this in. Because you've got a very deep and rich bond market, government bond market, so the US 30-year treasury curve, I've learned to love. Because you can build these longevity protections into it over a very long time period. So average life expectancy of an American at 65 is 20 years. That's well within the 30-year bond ladder that you could build, that an insurance company could build. So these are lifetime annuities. You give up, call it $100,000. You get $7,000 back every year for the rest of your life. And then there's a couple of provisions where it would cover you and your spouse. It could cover you for a minimum of 10 years or as long as you live. So what we've done, go ahead.
Because usually what I have heard a bit about the annuity market in the US is that it kind of is very expensive because a few people buy annuities, so people that buy them are the one that lives the most. How does this matter with this kind of product you're embedding in these target date funds?
Okay, so this is where we've got a couple papers on this that I can send over. The annuity market is like saying the investment market. So there's good investments, there's bad investments, there's cheap investments, there's expensive investments. There's different types of annuities. This type of annuity is, it's called a fixed annuity. It looks like a bond. These are not particularly expensive to operate, and they're very simple to operate. The more expensive annuities are called variable annuities, and they're called fixed indexed annuities. Those can get to be more expensive. This is a very, very simple annuity. There's problems with it, but it's a very simple annuity to offer. So we can offer this without any increase in fees within the target date fund. And we can offer this with liquidity up until the point that you decide to annuitize with that longevity, that lifetime guarantee. The pooling on this is fairly straightforward as well for the insurance companies. So it's not, they do use different annuity curves, different mortality curves. So the assumption is somebody that's buying an annuity will live longer. We don't find that as a major cost when we're building the annuities. Most important though, and this is the most important thing, when we implement the annuity into the spending, unless somebody's going to live a short life, less than 10 years at the point of retirement, there is almost no case where you're worse off owning the annuity in conjunction with the rest of the portfolio. Remember, this is only 30% of the portfolio in the US model. This isn't 100% of the portfolio. So 70% of your assets are still liquid. We're taking 30% of the portfolio, which provides this spending floor. When you do that, what it allows us to do is remove some of that money that we have to provision for you later in life on the possibility you're going to be alive. I don't have to do that anymore. I can take that money and I can now fund that to somebody in their mid-60s to their mid-70s when I know there's a very high probability of them being alive. So it makes the problem much easier for us to solve. There's a lot of information though. I'll send you the paper.
Thank you. We have 2 more questions, and we have 10 more minutes for your session. You're fine?
Perfect, yeah.
The time? Okay,
Yep.
perfect. So Manuel Garcia, and then Mike Clark.
So quick question then. So if I understood correctly, you say in that graph that with this new product, there is a decrease in volatility that I can understand perfectly because you are introducing the fixed annuity,
right.
And then an increase in spending. That sounds like a free lunch, although you commented very fast. Provided that you increase your savings. So what are we then talking about here? Are we talking about an increasing savings and therefore you get your results? Or what happens if people don't increase their savings? That's one. And second, over time, even fixed annuities will increase in price, right? Because longevity will keep increasing, so on and so forth. So what's your view about that?
Okay.
The longevity mortality tables are part of the pricing of the annuity, right?
Yeah, the biggest driver of the annuity price is going to be the U.S. bond market. So with the bond yields going up, they've overwhelmed any change to the mortality tables. So this was not particularly good 2 years ago when you had very low long rates in the U.S. The biggest driver of the price is the spread duration, is the credit spread, and the 20 to 30 year U.S. Treasuries.
So you say the numerator, the denominator effect is higher than the numerator effect.
Yeah.
But that depends on indeed rates keeping, high.
Absolutely.
Right? I guess that's your view. That's fine. Just trying to understand the logic.
The more people that buy these, the cheaper they'll become as well, because the pool gets bigger and the insurance company gets averages better. The less people that buy them actually makes them more expensive. But let me go. The first question you asked, I think, was really, really good. I want to make sure this is clear. The point I'm making on the savings, if you haven't saved enough money at retirement, there's very little I can do. So you have to have saved enough money at retirement. So if somebody gets to retirement, we'll use US dollars because I know them very well, and they have $80,000 in their retirement savings, I can't help you. I can't help you. So unless you saved, my point was, unless you saved enough money to have a lump sum big enough that I can take the annuity and make it worthwhile. Go ahead.
No, sorry. So low, what in the UK call, how do you call it? The small pots. The small pot problem would be probably an issue.
Yep. So the small pot problem we solve differently, which is Social Security. The age of claiming Social Security, and it's the same way with NSP in the UK. Every year you defer Social Security, very similar to the UK, you get a bump. So in the UK, I think it's 5.8% is every year you defer Social Security. The US, it's a little bit different, but call it 6% in the US as well. So for the individual that has not saved enough money, what they're going to do is they're going to live on Social Security. For the individual who has saved enough money, what we're able to do is take that asset, take 30% of the asset, we can turn that into the guaranteed annuity. They will get paid for the rest of their life. Some of the work we're now doing is called Social Security optimization. So what if I can get you to defer Social Security 1 or 2 years, get an extra 12% in Social Security? This gets a little bit more tricky, but let's go through this. Let's go to the UK. Mark, we should have a conversation about this later. What we're looking at in the UK is something different. So what we've talked about was a product in the US. This is the same outcome now that we're doing in the UK, but what we're doing in the UK is we're breaking apart the product. And we're breaking apart the product into 3 different outcomes. We're looking at the liquid assets, We're looking at how to optimize state pension and then whether or not it makes sense to buy a fixed annuity. One of the problems we're finding in the UK is because of some of the tax regulations in the UK or the tax provisions in the UK, you can withdraw, is it 25% of your assets? 25% of your assets tax-free. So what a lot of target date fund managers are doing or investment managers are doing is leaving 25% of your portfolio in cash late in life. What we're looking at within this optimization is if you just took that 25% in cash, took half of it, bought a fixed annuity, took the other half and put it back into the equity markets, what would that overall spending outcome be? Importantly, what you're looking at here is the same thing we showed you in the US product. This has just been a disaggregated product. So instead of selling you a product, we're talking about this being a digital tool that would optimize between liquid assets, the possibility, not the forced buying, but the possibility of buying a fixed annuity, and then when to buy or when to access your state pension. And we do this whole piece on the far right. We basically we're able to give you a higher total spending in retirement by breaking apart these pieces and adding in new asset classes. So that's the longevity. Longevity gets to be more complex. This is the professionalization, though, of spending.
Thank you. We are taking 3 more questions, and then we let Nick to finish, okay? So Mike Clark, Jimena Quintanilla, and Ursula Schwarzhaupt.
Nick, I want to congratulate you on making me think very hard. So this is a very presumptuous question, and I apologize slightly to my hosts for asking it. You know I like scenarios, so this is a scenario where I am the Chilean government. We have just decided we're going to do target date funds. And we sent out an RFP yesterday, but we're much more worried about climate change than BlackRock seems to be. And one of the conditions in the RFP is that BlackRock rejoins Climate Action 100 Plus globally because we want BlackRock to accelerate policy transitions. Do you think you'd be able to meet that commitment by the 1st of June, which is the closing date of the RFP?
That's a Larry Fink question.
It's a public favorite.
Okay.
What we've done, I'll answer it a little bit differently, and I don't think it's in here. I don't think we put it in this. This is our UK asset allocation. Again, as a practitioner, I have to deal with what I'm given. And if BlackRock's not involved in that, I can build a portfolio aligned with it, which is what we've done in the UK.
I mean, the reason I ask is that I'm working with one or two UK pension funds who are thinking of firing JP Morgan for the same reason.
Yeah.
Because wise asset owners are on average keener than investment managers on the risks,
yep,
especially US-based ones. So I'm just sort of interested in your sort of perspective on the policy issue, and I accept that US-based managers have a real problem.
Yep.
But I'm very familiar with a range of UK asset owner conversations that sort of the client gets presented with a problem.
So there's a balance that we have to make here, and let me answer the way that I would answer this correctly, and then I'll talk about some views that I have in actually looking at these portfolios. If BlackRock is or is not part of whatever the new agreement is, that's not for me to decide. I can influence. What we can do is build portfolios aligned with certain aspects. So we would have Paris-aligned portfolios, net zero 2050, net zero 2040. We can build those portfolios. The UK is our most advanced version of that. When we look at it across the world, other parts of the world look at this very different. Canada, we implemented a number of ESG changes in the portfolio, and we almost lost the entire franchise. So there was a large part of the Canadian market, a very vocal part of the Canadian market that wanted nothing to do with ESG. And as a mass market product, we have to be very careful with how we put ESG, or I should say sustainability, into some of these portfolios. However, if somebody came to us, if the Chilean government came to us, we could design portfolios aligned with whatever the Chileans wanted us aligned to. And that goes back to this slide here, where it should say somewhere on here, regulatory. Maybe it's not on here. Regulatory is one of the key areas that we would look at. And if the regulation was net zero, 20, whatever, Paris, whatever the regulation is, we could manage to that. The harder part is, and this has been my observation, is it's very difficult in the short term to strike a balance between sustainability and investor returns. Oftentimes, sustainability doesn't understand investor returns and vice versa. So you end up with portfolios that should be completely different than a traditional cap-weighted portfolio where we have to weight things in different areas. So you get huge factor biases that most of the asset owners don't actually anticipate owning, like a huge exposure to small cap companies or more startup type companies.
Yeah, I mean, just not for debate now, but I would slightly challenge that view when we replace sustainability by climate risk and the two come together, because certainly in the UK, we're extracting in some places climate risk as the key thing, systemic, and ignoring the rest of the stuff. So, I mean, that's a conversation for offline. Thanks.
Yes, thank you. I have a few questions about this threshold you did. So how do you determine that threshold? What is its level, say in the US or in the UK? Is it different for men or women? And what's the share of the population that is getting to that threshold to be able to be offered these products?
And this is the annuity product specifically?
Yes.
Okay. In the U.S., again, we have to deal with regulations. The U.S., in 401ks, I'm not allowed to differentiate between men and women. Everything has to be unisex in the U.S. So men are actually slightly better off in this, women are slightly worse off in this, but again, it's the regulations that we have to take. So the threshold, if I think of the threshold, everybody would get 30% of the annuity at the point of retirement. That would be the amount that everybody would get. And we've learned at this point, we've not given people the choice of more or less. It's either do you want it or do you not want it. The choice comes into when I can take it. So it's any time between you're 60 and 70 years old. There's a couple of different choices about do I want to cover my spouse or just myself. But what we found is if we take the 30% and we provide any choice around it, people will not take the annuity. So if I say 30% is the default, but you can go up to 50 or down to 0, people get very nervous and they say, well, this is confusing, I'm not sure, I don't want it. If we just say 30%, you can do it. There's a workaround to the system. We're not publishing it, but the people that really wanted more or that really wanted less, they can figure that out. As far as what is the income level, there's a separate paper that I can send to you in terms of the actual account balance. I don't have a great answer for you, and the reason why I don't have a great answer for you is a lot of it depends on what the individual wants to earn from the annuity. Think of the annuity paying out right now about 7.5%. So we'll keep my math simple. We'll just say it's 7% payout. If somebody has a $100,000 balance, is $2,100 a year good enough for them to take the annuity, divide it out by 12 months? We've put that in front of some people, and they said, yes, absolutely, I like that, a couple $100 guaranteed for the rest of my life, I like. Other people would say, no, I'd rather have the $30,000. So I don't have a great answer. When you get into kind of the middle areas, so $400,000, $500,000, $600,000, then the evidence becomes much more apparent that it does make significant sense, assuming you're going to live for about 14 years. It's about a 14-year break even currently on the annuity. My personal view is people with smaller balances, they're going to live on Social Security. In the U.S., Social Security is a very good benefit, and they really shouldn't take this and annuitize. People in the mid or upper, they should absolutely take it and annuitize. Social Security optimization is the most important point for the lower income in America.
Okay, thank you.
Ursula?
Okay, so now I'm curious about how BlackRock you are looking at big demographic trends and their effects in returns, because more or less what Manuel was talking about, there's have been a falling trends in return, and our generation will return in a world very different with a lot of people retiring and a lot of population in the world, so return are going to go down, or that's what we're anticipating. Do you have any views about that?
And the reason, it's an I don't know. There's a book that was written, I think it was 2020, 2021, by a British gentleman named Goodart, I believe, is who wrote it. He argued that you're going to see this different return paradigm happening. I've read a lot of these things over my 20-some years, and they sound great, and I'll talk to you in 20 years and let you know if he was right. So if you look at the experience of a lot of these markets, Japan flies in the face of this. If you think of what's going on now with AI, it could completely change this. So yes, demographics are very important. Yes, you can track demographics to very long-term returns. I wouldn't bet portfolios based on demographics, solely based on demographics. I think there's a lot of areas where we'll continue to see returns. I think the bigger risk, frankly, is debt than demographics.
Thank you very much. And just to add something to that, when you talked about expected returns, so what do? You do it like a band chart of options, like worst case scenario given history, or you have another way of
so we
looking
run
at the future?
Yeah, the way that we run returns, all of our returns. I don't know if I put anything in here on this. All of our returns are what are called equilibrium returns in our big portfolios, not some of our smaller portfolios. So the US portfolio, the UK portfolio, we're changing slightly, Canada. What equilibrium returns mean is we take very long-term views of markets. We don't try to trade valuations. We don't say this is cheap or that's expensive. We just take very long-term returns. If you want to simplify this, it's called the Grinholm and Kroner equation, which basically looks at long-term earnings growth, dividends, the change in PE ratio, the change in shares issued, and inflation. And when you actually look at this over very long-term periods, PEs generally mean revert. There's a little bit of a debate for that. Share issuance and cancellation essentially mean reverts to zero, and then inflation. So your very long-term returns are a combination of earnings growth, dividends, and inflation. That's how we think of the world. So we don't make changes very often to these portfolios because we want to see through business cycles because the time horizon is so long. We have models that are able to do better, and then they do better for a while until they stop doing better, and then they do worse for a while. And then as you kind of bring all of this back.
We'll let you finish now, please.
I think we've covered everything. Yeah, go ahead.
Yeah, but I said that only 3 questions, and then we move to the, okay.
No, go ahead, because I'm gonna turn over to Mark, because I think we've gone
last
way
questions,
over.
and then we move to the next.
Okay, my question is very simple. When you talked about annuity, you talked about the life expectancy. This annuity covers until life expectancy or afterwards? Because in our country, the problem is that some people live more than life expectancy, and that's where we have the longevity risk.
Right. So the way the annuity in the U.S. is done, it's until you, I'll kill me in the example, not you, until I die, that's how the annuity works. So the way the annuity is built is they pool many people together. The insurance companies are very good at mortality tabling. If there's one thing they're very good at, that's what they're very good at. Average life expectancy in the U.S. is about 20 years, half of the 20 years at 65. Half of the people will die earlier, half will die later. The people who die earlier fund the ones who live later. So this would be until the end of life annuity. Some annuity products are not built that way. A lot of that has to do with the bond markets in the specific countries. The bond markets aren't long enough to hedge that risk that the insurance companies have. But they're specifically, these are longevity annuities. So let me just summarize very quickly, Mark. There's no more slides. I'll just say this. The point I made, target date funds are not sufficient. We have to build in the benchmarks. We have to build in the peer groups, the peer awareness, and the risk management around target date funds. The simple build of a target date fund is not sufficient. It's all the other parts that go into the target date fund. That's the first thing that I would leave you with. The second one is think about the professionalization, not DB to DC, but the professionalization of all parts of retirement. Your objective is not to launch target date funds. Your objective is to help individual Chileans reach retirement and be able to spend consistently through retirement. Thank you.
Thank you very much. So quickly, I will introduce Mark Fawcett. Mark joined Nest as CIO in 2008 to design and shape Nest's investment strategy and has been responsible for investment at AUM. I have grown from £0 to more than 37 billion pounds. In 2019, he became CEO of Nest Investment, an FCA-authorized investment subsidiary of Nest Corporation, while relinquishing from the role of CIO in 2023. Mark has been an investment manager for over 35 years and has managed money at a variety of institutions, including the head of Japanese equities at Catmore and CIO at American Express Asset Management International. Mer has an MA in Math and Philosophy from Oxford University and an MSc Management from the London Business School. He has a non-executive role on the Defined Contribution Committee of the Unilever UK Pension Fund. So Mark, thank you very much, and the floor is yours.
Thank you, and good morning, everyone. So, just want to make clear something that sort of Mike talked about earlier, was the difference between asset owners and asset managers, and this varies greatly by country. So the UK and Australia, the pension funds are run largely by asset owners. So Nest is an asset owner. We have 1 million employers that use us. We choose different managers to manage the different asset classes, and we have it's trust-based, so we have a fiduciary duty towards our members to deliver the best possible outcomes, and the Australian super funds are mainly set up in that way as well. So we appoint asset managers. Now in the US, and this is going to be an oversimplification, which Nick may correct me on, the employers that have a pension fund appoint the asset manager, BlackRock or Vanguard, directly, whereas a lot of employers in the UK will go via the master trust, the asset owner, and pass over that fiduciary responsibility. And there's some real benefits to that, mainly about litigation. So our trustees can be sued by the members if they don't do a great job. The other benefit is for employers, someone may only work for them for 2 or 3 years and then move on, and they have this small pot. The small pot lives with us, but when Joe Bloggs, actually I'm not sure what the American for Joe Bloggs is, Joe Bloggs goes from McDonald's to Burger King to another employer that uses Nest, we just keep all the pots together. So we reconcile, we match. When Joe Bloggs comes from McDonald's to Burger King, we join up his pot, him to his pot from before. So his pot builds rather than having lots of little pots everywhere, which doesn't stop, if there's different providers, those pots multiplying, but it helps mitigate that problem. In a world where people stay with the same employer for years and years, but this isn't a problem you have to think about, but the structure of the UK and Australia really helps the member connect to his or her pension wherever he happens to be working. And that's a real benefit when we talk about engagement and thinking about retirement, etc. So what Nick's described is great, but it works a lot better. It's about 30-year glide path. Well, if you're only contributing for 2 or 3 years with BlackRock, and then you're contributing 2 or 3 years with Vanguard, because that employer's chosen Vanguard, at some point you've got to consolidate all those pots together, and it's very hard to understand what your retirement income is going to be. So as you kind of evolve the Chilean or your own systems, thinking about the structure of the governance and how members join and who are they saving with, I think is really important, and it's a structural thing which we're not really talking about today, but definitely worth thinking about. So Nest was set up in 2008. I joined it to set up the investment team, and we were very clear we needed some goals to achieve, and then some very clear objectives to meet those goals. And primarily it's around, and I talked about this yesterday, so I won't go into detail, about achieving these good risk-adjusted returns, and choosing our level of risk has been really important to us. But also, on the far right, building trust through managing reputational risks. I understand in the Chilean system that people have become dissatisfied with some of the returns, and they start chasing returns, and they start switching at the wrong time, as Nick said. All the evidence is that people who don't go into default fund, well-managed default funds, get much worse outcomes than if they stick with one fund for as long as they can. So building trust right from the start for Nest has been important, and that's why we invest sustainably and responsibly, which I'm not going to be talking about particularly today, but it's really important to make sure that members want to keep saving, I guess. So in order to do that, and knowing we were going to have a lot of members, although we were kind of anticipating 2 to 4 million members, so we've now got 13 million members, and that's still growing. So we have a third of the UK workforce as Nest members. So we've got a big responsibility, but we're also operationally, it's just really hard to manage those accounts by individual, and so what Nick didn't really talk about, but was kind of implicit, is the target date fund structure is so much operationally easier to manage the risk of different age groups through their life path, and by having target date funds, and I'll show you how we're evolving the profile of those target date funds to be much more customized to the individual ages. It's a really easy structure to change the asset allocation, to change the glide path, etc. And so I've kind of talked about this to some extent already, but managing the portfolios for different cohorts is really important, particularly when the regulations change. So in the UK, members used to have to buy an annuity at retirement, very latest at 75. The rules have changed, so now they can invest through retirement, and if we've got time, I've got a little slide about how we do that. Not dissimilar to BlackRock, but some important differences as well. And therefore, changing the glide path was very easy for us, because we just did it for the 10 funds of the people who were kind of approaching retirement. So the way we designed it was this 4 phases, and this is a little bit controversial, but if we start with a growth phase, so that's where most people spend most of their time. It's got a CPI plus 3% investment return net of cost target, and then as people approach retirement, we start reducing the risk, very similar to what Nick was showing, reducing the equity risk. And then, but we still have risk on through retirement, and we're investing members' money for growth while paying them an income and thinking about the longevity protection, which we're just about to put in place. The controversial bit is the bit on the left, if you can see it, the foundation phase, we call it. So at the start, members literally have no money, right? You come in, 22, you're automatically enrolled, you have 0 balance, and then you have your first contribution, and it's probably $10 or $50, or if you're lucky, $100. These people are young, relatively low wages. It doesn't matter whether I deliver a 10% return or 5% return on that $100 in the first couple of years, because it's going to give me 105 or 110. It's no difference. It's not like at the end where you've got $100,000 or $500,000 or $1 million, where that difference between 5% and 10% is really important. What we didn't want is members seeing volatility in markets and a big drop in the percentage terms of their very small pot, and saying, I prefer to spend this money on beer than contribute to a pension which isn't delivering any return. And we did some research with potential members, and that was exactly the reaction. They actually wanted to kill the person investing the money who'd lost from the money. You know, people are very sensitive to losses. So we had a lower risk approach, which you will not find anywhere else in the world, but it's been successful, and we've delivered above inflation returns for that. And the way we're trying to boost returns even more is by investing more in illiquid assets for those very young members. So we had very explicit targets for each of those different phases. Really important to Nick's point earlier about being able to measure success. Have we delivered on what we said we would deliver? But every portfolio, every phase has sort of multiple objectives, and sometimes you can find they're slightly conflicting, and you've got to work out what is the priority. Ultimately, it's about delivering a retirement income and building a pot big enough to deliver retirement income, but managing the risk through the whole process is really important. And it's not just volatility risk. So we measure risk primarily by volatility because that's what the industry does. But there's a whole bunch of other risks. Drawdown is one, climate change and risk is another, and thinking about how that's going to impact the portfolio. Keeping people saving, and stopping saving. If it's mandatory in Chile, maybe that doesn't matter, but in the UK, people can stop saving. And so it's really important that we keep them contributing. So again, I showed this yesterday, and I've got a more kind of advanced version to show you in a minute, but for the different phases, we have a range of different asset classes, and we will balance the asset allocation according to our risk profile, our investment objective, and where we see the opportunities. So there's a long-term strategic asset allocation, but we'll also make some tactical calls along the way. What we've done recently is kind of taken it to the next level. So what you saw was version 1.0. This is 2.0, where actually we're thinking about the portfolio on a more sort of total portfolio management approach and working out what the different bits of a portfolio need to do. So we've now got 5 sub-portfolios, and I'll show you how we lock them together. But each has a very clear objective and very different characteristics. So I'll talk a little bit through these. So the illiquid stable growth, that's primarily things like infrastructure, property, delivering sort of inflation adjusted returns often, a bit of private credit in there. So that is very suitable if you've got a very long horizon, but you want more stability, less volatility. So our younger members are very significantly in that sort of stable growth part. And then on the right, the higher growth, so that's really the engine of growth. That's dominated by public equity, private equity, high yield bonds, emerging market debt, sort of the super returning asset classes, and that's delivering most of the growth in what we call our growth phase. And then as you reduce your risk, things like capital preservation, liquid capital preservation is really important. Having things, cash, short-term bonds, etc., so that as people start taking money out of the scheme, they can access that. Nick talked about the 25% tax-free. A lot of people do that. A lot of people will take some money out at retirement to either pay off their mortgage or decorate their home or whatever. So having the availability of liquidity towards as people approach retirement is important, as is generating an income. So we have some specific income generating assets, things like property, income funds, bonds obviously can deliver that income, private credits, great income generator. And then finally, longevity protection, which we've talked about, and I'll discuss a little bit more, but this is basically a gilts ladder and a bond portfolio which manages the annuity risk, the annuitization risk. We buy an annuity later than BlackRock do. We buy a deferred annuity at the age of 75, which starts paying out at 85. So we don't need to put 30% of the portfolio retirement into an annuity. It's more like 20% or possibly even less, which has some real benefits around keeping things flexible for as long as possible, positioning this as insurance. If you're really lucky to live a very long time, this deferred annuity is going to start paying out so that you'll never run out of money however long you live. There's pros and cons to the BlackRock approach versus ours, but in terms of positioning for our membership, this resonated really well. So again, we have the 5 portfolios. We have all the asset classes underneath, managed by a range of different asset managers. BlackRock are in there. They manage an infrastructure debt portfolio for us. They manage cash portfolios for us. That's it at the moment. They keep pitching, but hey, you know. But there are illiquid asset classes in there, highlighted in red. So real estate, credit, private credit, infrastructure equity, and private equity. Sorry, people over on the right can't really see that. So managing illiquid asset classes in funds which do trade every day. We take contributions in from for our million employers, for 13 million members. We basically have money coming in every day. So being able to manage the illiquids in a portfolio which is broadly liquid is really important. And the target date fund structure is just perfect for doing this. So Nick mentioned yesterday in the US, it's really hard to get alternatives into some of these portfolios just because of the way the regulations work. In the UK, operationally for a lot of schemes it's difficult, but if you set things up right, and we have done that, we are able to manage that illiquidity risk and make sure that at any point members can put money in and members can take money out, and they're trading on the illiquid assets at a reasonably fair price, so that no one is systematically disadvantaged, but they get the benefit of the illiquidity premium. So our longest investments, infrastructure investments, are 20, 30 years. We've got a big renewables program. It did really well in 22, 23 when oil prices went through the roof and energy prices went up. So it's really important to get that illiquidity premium if you can operationally set things up. We might have some questions about that. So I said we've got these 5 portfolios, so you can see here how we blend them together. So for our youngest members, they've got a lot in the growth fund, the high growth fund. They've got a lot in stable growth illiquids. So that gives them that sort of lower volatility experience early on while generating as much growth as possible. But as we approach retirement, capital preservation in liquid assets, income-seeking assets, and finally longevity protection are what people need, and their exposure to equities goes significantly down. But there is growth potential in the income-seeking in particular. So it's not like we lose growth as people go into retirement, but we just reduce the amount of growth risk.
Mark, you mind taking questions?
No, please, okay. Sorry, and yes.
So we have the president and then Ursula Charford.
Thank you, Paulina. Thank you, Mike. I'm curious about the process and the method, how you choose asset managers. So I suppose you take into account tracking error and other metrics, but I'm curious if you choose them through these 5 types of funds or through asset classes. Could you please elaborate?
Yeah. So we choose managers by asset class, and we have a number of criteria. So one is a coherent investment philosophy and a performance which reflects that investment philosophy. Some managers will talk about all the great things they do, and then you see the performance and it doesn't align. So as Nick said, managers will underperform sometimes. What you need to know is what market conditions they're likely to underperform. So that's the first element. Secondly, it's got to be a robust business. So most of our managers are people that you would recognize as big asset managers, a few smaller boutiques, but with sufficient resources. And then the third element is sustainability. So responsible, sustainable investment is part of our, we say part of our DNA. It's a very strong belief that our managers need to be able to manage the risks of things like climate change, but not just climate change, just manage ESG risks generally. and have evidence of that and evolve it. So we've only fired one manager in 15 years, and that's because they refused to evolve the sustainability strategy. So basically what we are looking for is fees. Sorry, I should have mentioned fees. We are renowned for being very low payers, right? We pay no performance fees on our illiquid assets or our liquid assets. But because we've got very strong cash flow, we can negotiate very good fees. It's very valuable to managers to be getting that cash flow. So those are the key elements, and we have a team across risk, sustainability, the manager monitoring team, etc. But we all get together as a team to manage, to select the managers. It's a competitive process. It's very hard for the managers, but we've got all our managers bar one are outperforming, which is unheard of for a consultant like Willis Towers Watson. They would love that sort of success.
And do you have any, for example, ranking that could be useful in terms of knowing,
well,
especially for illiquid assets?
Yeah, it's. We can tell you who we use and why we use them, but often it's the price negotiation gets rid of 75% of them, if not more. A lot of managers, particularly in private market assets, want to be paid a performance fee, and they won't change that mindset. So, if you're paying 2 and 20, which is typical for managers, the performance has got to be that much higher, right, to get a good net return. So because we're paying a lower fee, we don't need the very best manager. What we need is a manager that's going to deliver us top quartile returns, net of fees. And if the fees are low, that's a lower bar to return. So that's kind of a critical part of the selection process.
Thank you. Ursula, followed by John Turner, and then Mike Clark.
Okay, thank you very much. I am curious about how you manage the asset allocation when you're targeting to people that have different type of deaccumulation products. For example, annuity, program withdrawal, lump sum, that you need more liquidity. Yeah. So you have a mix with different objectives.
It's a great question which we've been grappling with. So we have 2 retirement products. One is what we call our Nest-guided retirement fund, which is a combination of a growth portfolio, cash to take out as an income, and some longevity protection. And to Jimena's question earlier, the bar to get in, the level to get into that product is only £10,000, so about $13,000 US. So. But obviously the income's really small. It's about a 6% yield, something like that. And then people got a pot smaller than 10,000. We expect them to take as cash, and so they go into a very liquid fund, trying to match inflation, not guaranteeing it, but trying to match inflation. So if they leave their money there for quite some time, as some people do, they forget to take it out, or they don't need it now because they're still working, then at least they're trying to, not losing money in real terms. So what we want to do, which we haven't done yet, but one of the schemes in Australia has done it, is 10 years out is actually separate the glide paths. So you look at the people who are likely to have a pot more than £10,000, and their glide path de-risks slower than the people who we know are likely to take cash. So that's quite a big decision for our trustees to take, but you have to better predict, but it should be fairly easy to predict. Most people, it's the people on the border we have to make a decision about. But splitting glide paths to have more optimal de-risking and at retirement outcomes is a challenge, but is one that we think is important.
Thank you. John, please, followed by Mike Clark.
I agree with you that low fees is a really important issue. And I was just wanting to ask you, in basis points, what do you consider to be low fees?
Okay, so our fee level is fixed by government. So we have a 30 basis point AUM fee. So annual management charge, 30 basis point annual management charge to our members. And included in the 30 basis point is all the administration and the fund management, right? So until recently, my fund management budget was 12.5 basis points. So not everyone has to be under 12.5 basis points. So what should I say? A private markets fee would typically be somewhere between 30 and 50 basis points. A semi-passive or systematic equity fund is going to be, less than 5 basis points. I can't tell you how much exactly because it's secret, but is that sort of so? Public markets clearly cheaper than the private markets. What we don't pay is 1%, 2% carried interest, etc.
I'd like to build on Mark's comment about sustainability to the question from the President. One thing that's beginning to happen is not just looking at the investment product, but actually the business model of the investment manager. So I sort of gently disagree with Mark that we're not talking governance, because I think a lot of the investment issues become governance issues. So, for example, and I go back to my comment about Climate Action 100+, I'm working with one pension fund that is thinking of firing JP Morgan because they left Climate Action Plus. In another case, I was a non-executive director of an asset owner for about 4 years, and we think at the time, to persuade BlackRock they want to be appointed, we think we helped BlackRock sign up to Climate Action 100+, which they've now split. So I think one of the developing themes, and the reason I'm saying this is I hear a lurking thought of an asset owner thinking about how to appoint investment managers, which I think is a growing theme of mine in Chile. So I think the actual business model of the investment manager and whether that sufficiently accommodates not so much sustainability but climate risk that finance generally is doing very badly with, as I'll comment on this afternoon, but actually thinking, does this investment manager's business model do enough on climate risk and opportunity for me to consider them? So it's moving up from what's this fund, what's this product, what's this mandate, to what lies at the heart of the investment beliefs of the investment manager. Now, I mean, to Nick, that's more a European view. It's a view that's very challenging in the US because of the politics. And I suggested that Larry Fink, a few years ago, had 3 choices of business model to keep losing clients on both sides because they're a bit upset about being in the middle, or splitting the business into 2, or saying what he really thought, which we know. And he sort of chose a variation of option 2. So I think this is part of the professionalization, I would argue, of asset owners becoming very wise about the process of citizens' money, which they steward, which they then give to managers, which then invest in companies and come back to affect the citizen. Yeah. But so just offer that as a build on Mark's comment.
Yeah, and it's not just climate. So we look at the culture of the organizations we invest in. We didn't appoint one manager because they had a very high-profile sexual harassment case, and then the CEO sort of doubled down on it rather than try to resolve it in a way that satisfied us. So culture, the diversity of the team, cognitive diversity, gender, etc., to enhance good decisions. So there's a whole range of things, but trying to keep this succinct, I was not going to go into all the detail.
Okay, yeah. We have 2 more questions, and then we let How much time you need?
I'll take as much time as you like, but let's do the questions.
We have still 15, 20 minutes, so it's okay. So Manuel Garcia, followed by Octavio Balinas.
Thank you. How does the longevity protection works?
Yeah.
It seems like a deferred product, right?
Yeah. So the way we are looking at the longevity protection, we haven't put it in yet because we don't actually have anyone who's even reached 75 yet. So this is somewhat theoretical, but we're hoping to go to market soon. This is not public information, so please treat with discretion. And Nick, you might have to close your ears here. So what we're planning on doing is buying deferred annuities in bulk from insurance companies. So at the moment, the insurance companies in the UK are doing a lot of buyout business for DB pension funds. That business is going to run out at some point. So actually being able to write annuities for 10, 15 years' time in bulk is going to be quite attractive business for them, for the ones who are far-sighted enough to think beyond that. Not all companies are very long-sighted. So that's the way we're going to do it. So and what we can give them is the profile of all our members. We've already had it priced up just to get the illustration. So they get the profile of all the members in the cohort that we want to buy the annuity for. They price up the annuity, as Nick alluded or mentioned earlier. The more lives you have, the more diverse it is, and that deferred annuity will be bought at 75, starts paying out at 85 for as long as people live. The challenge, and it relates to a question we had earlier, is so we would like to default people in. So if you're in our retirement product, we want you to be defaulted into an annuity, which obviously locks up your money in a way that's never been locked up before. And so rather than opt in, you have to opt out of that. So this is legally interesting, I think, but we believe our trustees have the power to do it. I mean, it's actually written into the law. We have the power to buy annuities for people. So we are managing that, bearing in mind most of our members have never taken financial advice, never will take financial advice. If they take financial advice, it's from a relative who knows nothing either. So it's really important that we design this really well, but that meets members' needs.
So can I just follow up very quickly? So are you worried that if it's not mandatory or default, if it's not a default, you'll get a selection, and then must be priced?
Yes, so the selection bias was an issue on two counts. So one is if people opt out of it, why are they opting out of it? Do they know they're going to die soon? So one of the things we would like to do is, if people have got a health condition or they smoke or have a lower life expectancy, is point them towards specialized annuities which meet those needs. So they should probably be buying an annuity now, which they can get special rates on. The other selection bias issue is, we think this is a great product. We designed this product in 2015, but haven't been able to fully implement it for reasons too complex to go into. So rich people will see, oh, this is a good product. It delivers growth. It's low cost compared to most of the retirement products in the market. I get some longevity insurance. I'll put £1 million in, right? Those people are going to live longer than most of our members who are on minimum wage or low wages. So our poor members will be subsidizing our rich members. So we need to think about how maybe we cap the size of people coming in. That cap will rise as balances grow, but so that's an issue which we really care about our members, and the fact they are lower paid, and the financial services industry does not generally deliver good products for lower paid people. The last thing we want is for rich people to be taking advantage of that.
Octavio, and we continue with the presentation.
Thank you. Good morning, Mark. I will try not to deviate too much from the glide path discussion, but I was very surprised by the figure that you mentioned you pay on alternatives, 30 basis points. So my first question will be, you're accessing brownfield infrastructure and real estate funds, not private equity, I suppose. And also, how do you access those funds? Through UCITS, AEFs, or to GP-LP normal agreements?
So it's a combination, right? So our first move into real estate was through a big fund, but because it was a big fund already, the fees were relatively low. And real estate tends to be cheaper anyway. So it's UK direct property, big fund, which we're part of. And with that manager, we've negotiated some other deals on the side because we're a big client. We get special deals. Then in infrastructure, we do greenfield and brownfield. So our renewables program is building new wind farms and solar farms, but also buying operating assets. Infrastructure price fund management fees have come down a lot, so we're able to access that. Private credit, and so that's a combination of co-investment and funds. We seeded a couple of new funds. Private credit are basically LP structures, but for funds of one. So they're separately managed accounts for us. We help seed a couple of products for private credit managers, but basically, again, we went to the market and said, look, you're going to be getting £100 million a year from us, possibly more if you do well. That's £100 million. You don't have to go and raise for fund, Series 5 fund or 6 fund or whatever. So basically that cash flow, we're taking in $8 billion a year in new cash, which we're spreading around our asset managers. So that's really attractive to private credit managers. Private equity, we invest only in co-invest. So we use two managers. They have big, strong GP relationships. So they're investing other clients' money in the GP funds, the main funds. That throws off co-invest. We just invest in co-invest. There's no GP fee on the co-invest. So we're just paying our Schroders and HarbourVest, it happens to be, the management fee for doing that. And so far, so good. We have very ambitious plans in this space. We're going to do some more innovative stuff, but it's the power of money, and also, and this may play in this market as well. People want to work with Nest because we're doing something good for society. And asset managers don't spend all their time doing good things for society. So this is something, a relationship they can really value and talk about.
So these are total expense ratios, right?
Yes.
You're not paying
No, these are TERs. Yeah.
Okay. Thank you.
Yeah. Right. So let's continue. I'm almost there. So basically. We have this diversified strategy. You can see the blue here. That's equities, global developed market equities. So that is the main asset class, but then we've got a range of other asset classes which we use in different ways, as I discussed. And then this is by asset class, the sort of the member journey starts off with a lot of equities, but that goes down later on. So just for the 5 portfolios, I just want to give you a taste of how we put them together. So for the high growth portfolio, we have, it can invest in any asset class that we use, as long as the returns are attractive enough. Because clearly there are times where bonds are very unattractive and times where actually they're really attractive. So we wouldn't want to exclude them. In the high growth portfolio, so we put together, the top line is the official frontier, with no constraints, and the red line is the efficient frontier with cost constraints and some asset class constraints, how much we can put in any individual asset class. So slightly lower, and then we just map out all the possible portfolios, and this is higher growth, so we're choosing a portfolio to the far right to maximize growth relative to risk. But we do that for all 5 portfolios, and clearly the risk dimensions on an income portfolio is different to the risk dimensions for a growth portfolio, and that's a problem we are working through at the moment, rather than to say we've solved it. But making sure those 5 portfolios are as optimal as possible is really important to getting the good outcomes, particularly as we are taking less risk than your average master trust, which I'll show you in a moment. Just two important more slides. So this one I showed yesterday, having this internal market for liquid assets is vital operationally, so that as members approach retirement, they're not trying to sell their private equity or their infrastructure into the market. We've got lots of cash coming in to absorb those assets with our younger and middle-aged members, so people are able to reduce their illiquid assets without any frictional costs. And then this is the final one, so apologies. So basically there's an organization that looks at performance, risk-adjusted performance for all the big master trusts in the UK, so the multi-employer schemes like us. So the red dot here is the top 10 providers. So you could view it as our competition, or basically the market, really. That must have 90% of the assets, at least in the DC market. And this is where we are. So we're delivering above average returns at significantly lower risk, so volatilities along the bottom. Now, that's what our board wants. That's where they want us to be positioned. So Aviva up here, one of our competitors, is clearly going for high growth at high risk. And that's fine. You choose your place in the market. Nick was talking about that yesterday. Our membership, we know, have less risk capacity and less risk tolerance than a lot of employees in the UK. They've got 30% lower average earnings, and the challenge is actually, are they contributing enough? But Social Security or state pension will provide a significant underpin to their pension, and the Nest pension will be a nice top-up so they can afford to switch their heating on, so they can afford to buy presents for their grandchildren, not to buy yachts. Our market is not about buying yachts. So by blending the portfolios as we've done, as using illiquid assets as we've done, by not being fixated on how much equity we can get into the portfolio, we've positioned ourselves in the market in a higher Sharpe ratio than pretty well everyone in the market. So, and that's exactly where we want to be. We could leverage this portfolio and get right up there, and that would be an efficient portfolio, but it would obviously be more volatile. And at stress times when we have people like Liz Truss as our Prime Minister, it could get a bit exciting. So, so that's, I think that's the main thing. We do have this retirement product, which I can talk about a little bit more, but basically it's about generating a regular income, as Nick was talking about yesterday, and having the longevity backstop for if you live longer than 85, and that allows you to spend all the rest of your money right up to 85. You're not trying to hang on to that little bit of extra money because you don't know whether you're going to need it or not. It's really having some sort of annuitization in there at some point really makes a difference, as Nick's sum showed earlier, between being able to spend your money efficiently in retirement or having far too much money at, we don't talk about death at Nest, we talk about the end of retirement, so it's...
It's true.
That's all I want to say.
Thank you very much.
Yeah.
We have 10 minutes for discussion, and already we have 3 questions. Ursula, Octavio, followed by Manuel Garcia.
Well, first of all, I really like the philosophy of Nest of keeping the hard decision out of the people. I think you have really nailed it there. I'm very envious. I was wondering if you have built an indicator of the performance of the funds based on the cost of a pension or the stream, the constant stream Nick was talking about, the constant purchasing stream?
We have, but it's still under construction because we haven't got the longevity bit in place. So until we start actually buying deferred annuities, and we've got a good model for pricing them, so that's the bit we're working on at the moment, is how do we price those deferred annuities? So how can we then work out how to calculate the likely income in retirement? The UK regulations are very strict about how you illustrate future income, and they're completely unrealistic. They just make no sense at all to certainly any practitioner. And I think it's misleading as a result. So people used to be able to choose the level of return they were assuming to deliver the income, irrespective of whether they invested the money in that way or not. So the government wanted to crack down on that because people were obviously just pretending they were going to get 7% returns when they were likely to get 3% returns. But as is the way sometimes when regulations are drawn up, you solve one problem, but you create another problem. And that's what's happened in the UK. Fortunately, most people don't read those statements anyway, so it probably doesn't matter. But sorry, apologies.
It's okay. So Manuel, and then, no, not anymore? Okay, so Rosario, please.
I have two questions. First one, very simple. You said that you have, let's say, like a clearing system for illiquid assets internally. I wondered, how do you evaluate those assets in order to change it from one TDF to the other?
Can I answer that first? Because I might forget that one if you did answer next. So the way we do it, we have regular valuations for all the private market assets. Bear in mind, so we've got a 20% target, we're going to 30%, but the private market assets aren't all correlated anyway. But basically what happens is we get regular valuations, but there's a lag, which we know. But if there's a significant market move, so the indicator is if equities drop 20%, we'll have a look at or go up 20% very sharply. We'll look at our private equity portfolio. Do we need to revalue it? So an example would be, say tech companies crash, so the Magnificent Seven crash. We don't have very much tech in private equity portfolio at the moment, so we might not need to revalue it. It's only the tech companies are going down. If it's the whole market coming down, then we should be revaluing our PE portfolio. So we'll override the official valuation until a new valuation comes in.
So how often do you evaluate portfolios?
So it varies by asset class. So property is monthly. That's our biggest position. Infrastructure is quarterly. We might have monthly adjustments for foreign exchange, but quarterly. Private equity is normally 6 monthly.
I have many doubts, but then in the coffee break I asked.
Yeah.
And I forgot the other question.
Okay, so yeah, one of us had to forget. So I would just make a point on the private market. We know it's not perfect, right? There are people coming in, they're coming out. The price they are trading at is not the price we could sell or buy in the market. We know that. But at the same time, the benefits of investing in illiquid assets outstrip those, because I'm only putting £100 in a month. Okay, I'm paying a slightly wrong price. Next month it'll be a slightly different wrong price. But at the same time, I'm getting an extra 1%, 2%, 3% illiquidity premium. That is worth paying the slightly incorrect price for. The other thing is, the prices in the public markets are not the price you can necessarily buy and sell at. Right? It's yesterday's close, or it's a corporate bond that hasn't traded for a month. So people think public markets give you precision in pricing. They don't. It's an illusion. So that's why we think, but it's the best we've got. So as long as people can't arbitrage it, which I think is a concern here, because people seem to actively switch funds. So one needs to think about that.
In my country, people don't usually come in and out from a fund. But what happens is that we have certain paths that we certain pace that we have 3 funds: growth, accumulation, and retirement. And when you reach certain age, you start changing through a 5-year period from one fund to another. And we have the problem for how to evaluate illiquid assets when you change from one fund to another, because you take what you have already saved in one fund to the other. And that's why I ask you, how do you evaluate that?
Yes, because we're not switching funds, we're just doing some assets which is within the target date fund. You don't have that sort of blunt, right, I'm selling the whole fund at this price and buying, which is why, as I started, the target date fund structure just gives you a lot more flexibility around. So the moves out of illiquid assets are really small, it's once a quarter, a little bit, and your whole fund is building up. So you might not even be selling the whole position over 5 years, so,
Okay, thank you very much. Rosario's countries is Uruguay, just to let you know.
Yes, okay.
Well, we have no more time for questions. I want to thank Nick and Mark for the truly interesting session, really.